The transaction happens in a parking lot in Pasadena. No lawyers, no wire transfers, just two grown men exchanging $4,500 in cash for a sealed cardboard box containing several kilograms of plastic. This isn't narcotics. It's not stolen electronics. It's a Lego Millennium Falcon, set number 10179 to be exact. And the buyer just made what Wall Street would call a rational investment decision. Here's the part that breaks your brain. Between 1987 and 2015, certain retired Lego sets appreciated by an average of 11% annually, according to academic research. That's not a typo. While your index fund was navigating multiple corrections, while Bitcoin was having its existential crises, and while gold bugs were screaming about inflation hedges, a Tatooine moisture farm built from injection-molded ABS plastic was quietly outperforming them all. The S&P 500, about 8 to 9% annually over that period. Gold, roughly 7 to 8%, some retired Lego sets, returns exceeding 1,000% since discontinuation. But here's the question nobody's asking. How did a Danish toy company that was literally bankrupt 20 years ago accidentally create an alternative asset class worth billions? And more importantly, why are hedge fund analysts now tracking EOL dates with the same intensity they used to reserve for Fed meetings? The answer involves a near-death experience, a marketing pivot that changed everything, and the discovery that nostalgia isn't just a feeling, it's a currency, and it compounds. Let's rewind to 2003. Lego wasn't building an investment empire, it was building its own coffin. The company was losing approximately $1 million per day, not per quarter, per day. By 2004, the family-owned business founded in 1932 was staring at $800 million in debt and genuine bankruptcy proceedings. For context, this would be like Disney going under during the Renaissance or Apple collapsing after the iPhone launch. So what happened? The complexity trap. In the late 1990s, Lego made a catastrophic strategic decision. They stopped being a brick company and tried to become everything else. They launched video games, theme parks, clothing lines, and television shows. They created sets with so many specialized single-use pieces that manufacturing costs exploded. The average set in 2003 had components that couldn't be used in any other product. They abandoned the core principle that made Lego valuable in the first place: the universal compatibility of a simple brick. The product line expanded from 6,000 unique components to over 12,000. Inventory management became a nightmare. Kids stopped buying because sets were too complex. Adults weren't buying yet because Lego still positioned itself exclusively as a children's toy. Then came the diagnosis from management consultants: the brick is dead, kids want screens. Every analyst agreed. The death of traditional toys was inevitable, imminent, and irreversible. Lego was a 20th century relic in a PlayStation world. But here's where the story pivots, because someone inside Lego looked at the data and noticed something the consultants missed. There was a small, statistically weird demographic spending absurd amounts of money on Lego. Not kids, not parents buying for kids, adults buying for themselves. And they weren't just buying, they were hoarding. The acronym is AFOL, Adult Fan of Lego. And in 2004, this demographic was a market research curiosity. By 2015, it was a business model. By 2024, it was the business model. Here's the economic revelation Lego stumbled into. Adults don't want simple bricks. They want complexity. They want challenge. They want 7,500-piece architectural recreations of the Roman Colosseum that take 40 hours to build and cost $550. But more than that, they want exclusivity. This is where the licensing deals changed everything. In 1999, Lego signed with Lucasfilm to produce Star Wars sets. In 2012, Marvel, In 2020, every major IP from Harry Potter to Friends to The Office got the brick treatment. Suddenly, Lego wasn't selling toys, it was selling licensed collectibles with artificial scarcity baked into the production model. Here's how the math works. A Lego Star Wars UCS Imperial Star Destroyer retails for around $700. It contains 4,784 pieces. Production costs are estimated at a fraction of retail. Lego's gross margins reportedly exceed 70%, though they pocket significantly less after retailer cuts and operating expenses. But here's the kicker. Lego only produces these sets for 18 to 36 months. Then they retire them permanently. No reprints, no back by popular demand. Once a set reaches EOL, end of life, it's gone forever. This isn't accidental, it's architectural. Because the moment a set retires, the secondary market wakes up. That $700 Star Destroyer, often selling for $1,200 to $1,500 sealed on BrickLink, the Hogwarts Castle from 2018, frequently listed at $2,000 plus, the Holy Grail, the Taj Mahal from 2008. Authenticated sealed units have sold for over $5,000. Lego accidentally discovered what luxury watch manufacturers knew all along: scarcity creates value. But unlike Rolex, Lego's scarcity is guaranteed. There will never be another print run. The supply is capped, demand is only increasing. And the demographic buying these sets? They're millennials, hitting peak earning years with disposable income and a Pavlovian nostalgia response to the plastic bricks they played with in 1998. Let's talk numbers, because this is where the investment thesis either holds water or collapses into a Reddit meme. In 2015, researchers at the Higher School of Economics in Moscow published a study analyzing 2,322 Lego sets sold between 1987 and 2015. The conclusion: Lego appreciated at an average annual rate of 11%, outperforming gold, stocks, bonds, and art over that period. But averages lie. The real story is in the distribution. Not all Lego sets appreciate. In fact, most don't. Licensed sets, Star Wars, Marvel, Harry Potter, tend to appreciate at roughly 12 to 15% annually, post-retirement when successful. Original IP like Lego City or Lego Friends often flat or below inflation. The winners are predictable. Large flagship sets, 3,000 plus pieces, $300 plus retail, limited production runs, convention exclusives, short retail windows, strong IP attachment, Star Wars Original Trilogy, Harry Potter, pop culture timing, sets released during peak franchise moments. Let's model a real example. The Lego Creator Expert Modular Building Series. These are adult-focused architectural sets released annually, each retailing for $150 to $250. They're produced for exactly 2 years, then retired. Take the Parisian Restaurant, set 10,243. Released in 2014 for $159.99. Retired in 2016. Sealed market value has been tracked at $400 plus in recent years. That's a substantial gain, averaging double-digit annual returns. Compare that to the S&P 500 over similar periods, approximately 10 to 11% annualized, including dividends. But here's the structural advantage Lego has over equities: very low correlation to market cycles. The 2020 COVID crash, Lego prices surged as locked-down adults panic-bought nostalgia. The 2022 bear market, Lego secondary values largely held. Inflation, Lego prices tend to rise proportionally because they're physical goods with fixed supply. This is what asset managers call non-correlated returns. And it comes in a cardboard box with assembly instructions. The infrastructure around Lego investing has become surprisingly sophisticated. BrickLink, acquired by Lego itself in 2019, is now the central marketplace for LEGO trading. Real-time pricing data, historical sales tracking, condition grading standards, verified seller ratings. The platform processes millions in transactions monthly. Then there's the storage question. Serious LEGO collectors don't keep sets in their garage. They use climate-controlled storage with humidity controls, UV-protected shelving, and insurance policies. Some have formed LLCs, specifically for LEGO asset management. There are even small LEGO-specific investment funds, niche vehicles where accredited investors can buy shares in portfolios of retired sets. The market remains tiny compared to traditional collectibles, but it's growing. The thesis is simple. As millennials age into their 40s and 50s, nostalgia spending increases. As global wealth grows, collectibles markets expand. As LEGO continues its aggressive licensing strategy and retirement schedules, the supply of investable sets remains constrained while demand grows. But there's a darker layer here. This market is largely unregulated. No SEC oversight, no fraud protections, no standardized grading like you'd find with coins or comics. Authentication is often visual inspection. Condition disputes are settled on forums. Counterfeit boxes exist. Resealed sets exist. The market runs on trust and reputation, and yet it keeps growing. Because at the end of the day, LEGO figured out something most companies never do: how to make people pay premium prices for the privilege of remembering their childhood. That's not a toy business. That's a memory business. And memories, apparently, can appreciate faster than the S&P 500. So here's what we've learned. A company that nearly went bankrupt in 2003 accidentally created an alternative asset class by targeting adults, weaponizing nostalgia, and engineering artificial scarcity. The result? Returns that rival or exceed traditional equities with very low correlation to market cycles. Nostalgia isn't just a feeling, it's a currency, and like any currency, it compounds over time. But if you think plastic bricks are a weird investment, you haven't seen anything yet. Because there's a retailer in America that deliberately loses money on every single unit of their most famous product. Not to drive foot traffic, not as a loss leader, but because the CEO made a handshake deal in 1985. And breaking that deal would cost them something far more valuable than profit margins. I'm talking about the $1.50 hot dog at Costco. And the economics behind why they'll never raise that price might be the most brilliant business decision you've never thought about. But that's a story for next time.